Right, it's time for a portfolio update. We've got a hell of a week. We've got a lot going on. I'm going to go through my entire portfolio. I've spent a fortune over the course of the last week as well. I think about £6,500 into the market. Let's have a look at what I've bought. Let's have a look at what's going on, and let's go over my holdings. So first of all, we've got a pretty serious time of uncertainty at the moment. Trump getting involved in the Iran piece, right? We're not going to get into politics here, but it could create some significant uncertainty in the markets and your portfolio. Waking up this morning, as you can see here, I'm still up over the last 24 hours, 0.6%, but there are some tensions starting to happen, and it could have a massive impact on the portfolio. So at the end of the day, if Trump gets involved in this, we already know that Iran have got the backing of North Korea, of Russia. This could become significant. Now, like I say, I'm not one that gets involved in the news or politics or anything like that, but when it affects your portfolio and could potentially affect it, I anticipate we might see some drops over the course of the coming days, right? That on top of the fact inflation numbers are out today. They are at 3.4%, which is slightly less than they expected. Food is up, household goods are up, but transport is down. Now, the Bank of England have anticipated that between July and September this year, it's going to peak at around 3.7%. Who knows what's going to happen? They get it wrong all the time as well. And then they anticipate from September onwards, it's going to flatline to around 2% again. But again, we don't know what's going to happen. So let's get into the portfolio. Here it is. We're at £127,000 now on the one-day view. Like I say, we're up. On the one-week view, we're down 0.7%. 1 month up again, 0.6%. 3 months, we're now up on 3 months. So we've ridden the wave of April, which was bloody horrible, and we're back up again. So over the course of the year, that now means we're nearly just short of 9% up. On the max view, 45.5% up. Always important to zoom out. So let's go over the holdings. Biggest one I've obviously got is the Invesco FTSE All World. That's up now 5.68% on the year. You can see my buy point there. That's where I've averaged in at. So my average price is £4.95, and it is currently at £5.25. So I'm going to hold this for probably my entire life, I think, and it is now my largest holding by quite a bit. Got £63,000 in here, so just 6% increase there. Represents £3,600 up. Now this is the second All World that I have held. I did hold the Vanguard one before, so I am actually up a lot more than that, but I've banked some of those gains. Second biggest is Vanguard S&P 500. I have 34,129 in there, and I'm up just short of 20%. That's despite going through what some people were saying was a market correction that we would take decades to recover from. So it's a perfect example. You just need to block out the noise. Over the course of April, you should have seen my comments on TikTok. Oh my God. So many people sold out and they missed out on the gains. That's when we get the biggest gains, after a decline. It's happened forever. It always happens. We see a big decline in the market, then we get massive gains coming out of it. That's how it works. My iShares NASDAQ US Biotech, it is struggling. This is a thematic ETF is what they call it. So it has a specific theme associated with it. This is biotech. I've only got about £4,000 in here, 5% down. It is dividend paying. I've got the dividend paying version. That's going to be coming soon. But I've currently got no ambition whatsoever to sell that. Right, before we go into the individual businesses, let's just have a look at the purchases that I've made over the course of the last few days. So to do that, we just click the three lines in the bottom right hand corner, go down to history, look at orders. We can see the purchases that I made. So I put £5,000 into the Invesco All World yesterday, £546 into my S&P 500, and then I topped up a couple of my dividend-paying UK businesses that I really like. So £300 into Aviva, £300 into Lloyds Bank. We're going to cover those in a bit, and that comes to around 6,200, something like that. That then puts me in a position when I look at my portfolio, go up to the top. My ISA allowance is currently sitting at 15,596 deposits, so I've got 4,400 left. I'm hoping to max that out this year, and I'm hoping to put a dent into my wife's ISA as well, so that we can get £40,000 into the market. I don't think I will, but that's the plan. Right, let's go down and have a look at some of these businesses. So first of all, Legal & General. March's numbers were in for Legal & General. It's in line with what they expected, and they anticipate further growth and buyback. So buybacks are really good for dividend holding businesses. It means that your allocation into that business basically gets bigger because there's less shares available. So when the business buys back the shares, there's less of them on the market. Your position, in theory, therefore is bigger. Legal & General paid a dividend recently, one of the biggest dividends I've ever had. So you click the three dots at the top right hand corner, click on history. We can see their dividend of £208.17. As you can see, straight away, I rebought back into that business. That's what I do with every single dividend that I ever get. By the way, if you haven't already started on Trading 2 and 2, you can get a free fractional share by using the link in my bio and depositing £1. You'll get anywhere from £10 to £100 for free just for doing that. You can also use promo code Neil. Terms and conditions apply. Capital's at risk, all that sort of good stuff. So Legal & General, looking a bit further down, down. It pays a really tasty dividend. The dividend is at 8.36%, which if you were to just get that growth and the stock was to plateau, I'd take from a UK business. That's a really good place to be. It pays that dividend on a biannual basis, which means it's twice a year. The last one was over the course of the last few weeks, and the next one will be in September. Now, the big one is that one that just paid, and it's a slightly smaller one in September. A lot of UK businesses pay biannually for some reason, and US businesses pay 4 times a year, quarterly. So obviously with UK businesses, you don't pay any withholding tax. So it saves a bit, but you do pay stamp duty when you buy it and sell it. So it's worth bearing those two things in mind. So Microsoft, let's have a look at that. I got £3,500 in here, up 55%. Now, the market thinks that Microsoft has taken AI really seriously and has done a good job of it. And they're anticipating that the performance is going to be good over the course of the next few years. Again, this is analysts and they get it wrong as much as they get it right. So 55% up. It is a dividend payer, but a tiny dividend payer. It pays at around 0.68%. You barely get anything off even what I've got, £3,500. Over the year, then it's 8% up. Typically, before the last 12, 18 months, it's been growing by 40% a year, Microsoft has. That's obviously not sustainable going forward, given that it's one of the biggest businesses in the world already. Over the last 3 months, it's really recovered from that April dip, as the market does anticipate that it really is leveraging into AI really well. So I'm going to continue to hold it. I'm more than happy with it. Realty income. So the good news story with realty income, I am 10% down. I bought it at the worst time. It's my fault. But I went heavy into it early doors. I wasn't properly buying it when I should have been buying it, but I'm still happy with it. So realty income now has increased its dividend by 131 consecutive quarters. It has increased its dividend every single year since it IPO'd in 1994. It is one of the strongest dividend payers in the world, and it pays on a monthly basis, and it's got a really high yield. So currently the yield is 5.53%. I anticipate that there's no risk to this business at the moment. I say no risk, obviously there's risk to everything, but from my perspective, I'm comfortable to hold it despite being 10% down and getting that dividend coming in. Market anticipates that there is continued room to expand from here, and they do see growth within this business going forward. One of the quotes I saw is it's got a rock solid foundation. Now that's going into the details and the numbers, which we're not going to do today. We could do a whole video on realty income if we wanted. So 5.53% current yield, a growing dividend on a quarterly basis for 30 years. Gives me no reason to be of any way concerned about a 10% decline. Lloyds Bank then 52% up. Absolutely bloody smashing it. On the 1 day view up, on the 1 week view up, 1 month view up, 3 months the same, 1 year the same, max the same. So 40% up in 2025 alone. It is one of the biggest winners in the FTSE 100. There's a 15% increase in dividends been announced recently, and it has a really stable, pretty good dividend. The yield, did I say it already? Can't remember. Oh yeah, it's always wrong on here. The yield is currently just over 4.15%. It's not necessarily always the case that we need to go after massive dividends, because that can put us in a position where we're in a yield trap. So I'm really happy with it. The performance alone is putting most US tech Goliaths to shame, and it's a UK bank. Now, management also expects that we're going to see growth over the course of the next couple of years, and they've actually predicted that we might even break £1. So Lloyds is at the moment 76p, so another 25-30% growth in there. I think that'd be pretty bloody tasty. Aviva then, so I'm up 30% in this position. I'm up more than that because I originally held it in Hargreaves Lansdowne when I was paying those ridiculous fees, and I was up about 40% in there. So I banked that, moved it across, and then it's grown another 30% in my portfolio since then. So I've got £2,800 in here. Dividend yield is coming in at 5.84%. Another one, because it's UK based, that pays biannually over the course of last year, then 28%, 3 months, nearly 9% up over the last month, 3.5% up. So it's going in absolutely the right direction. And I've held it now for about 5 years pretty much since I started. So I'll continue to hold it. Really happy with it. Unilever. Problem with Unilever at the moment. Let's have a look at this first of all. So up over the day, down over the week, down over the month, slightly up on 3 months, and slightly up on 1 year. When you look at other UK businesses, it's not competing really. On a max view, it's all over the place. It's a roller coaster, this one. It's up and down. Now, Unilever does have low growth expectations. It's got margin challenges, and the products that it sells is suffering a little bit from aging a little bit. Are they going to be on trend going forward? The likes of Lynx, things like that. Are they keeping up with consumer demand? So there is a bit of risk with Unilever, but I'll still hold it. In total, I'm up 15% up. It does pay a dividend that comes in at 3.12%. So it's a lower dividend yield, but I'm happy with it. And it spreads my diversification as well. So it means that I've got consumer goods in the UK covered. So I've got consumer, I've got finance in the UK, I've got global tech businesses, US tech businesses, but this is not just a UK consumer business, this is a global UK consumer business. So you get the benefits of having a UK dividend business, which means you don't pay the withholding tax, but it also has global exposure and it sells in hundreds of countries across the world. Google or Alphabet, another business that the market thinks is doing a really good job of dealing with AI. So AI is a big trend at the moment. Obviously, some people have been asking me whether they should just put all their money in to AI ETFs, just consolidate everything into a few AI businesses. I really don't think that that's a good idea. Is it a hype business? Now, we all know what happened in the dot-com bubble. You just put .com at the end of your business name and your stock went up by 100%. That feels like that's what's happening at the moment. You put AI specialist in your business description and your stock price goes up. Now, there will be some significant winners in AI, I think, going forward. But are we going to be able to pick them? Could you have picked them in 1999 when the market absolutely tanked and only a few winners came out the other side? It took years to recover from that. Now, I don't know if we're in that sort of territory, but I see AI as big a revolution as the internet was in the late 90s. But there was a big crash because it was so hypey. So I think Alphabet is in a good position to take advantage of that because of the amount of cash that they have. Basically, it's as simple as that, the amount of R&D spend that they do. So the next one then is Apple, which is pretty quiet, really. Over the day, up 0.5%. Over the week, down. Month is down, and 3 months is down. Over the year, it's down as well. So it's struggling with the tariffs piece, the fear that the cost of goods is going to go through the bloody roof going forward. So it has seen a bit of a drop. Now we zoom out, 600% up since, let's click here, 2019. Now you'll take that all day long, wouldn't you, if you went in 2019? I bought my average in prices around 2021s, which means that I am up by 30%. It is a small dividend yield payer again. So having a look at the dividend yield, it's 0.52%. And US massive Goliath tech businesses, they're all pretty similar in that. Now, if you're buying in now and it continues to grow, obviously your yield on cost is going to get much better. Next one then is Johnson & Johnson, which is the world's biggest healthcare product manufacturer. And this is having a torrid time of it. It's actually up over the last day. Over the last week, it's down 2.5%. Over the month, it's slightly up. 3 months, it's down. 1 year, it's up slightly, but my position is down by 12%. You can see that dotted line. Again, I bought in at the beginning of my journey in a terrible time. Got me timing all wrong with this one. But I still hold it because I still believe in it going forward, and I still want that diversification of a global healthcare business. So I'm comfortable with it. The dividend yield is 3.29%, so it's relatively low. But look at that, the PE ratio is low as well, 16.81. We've got earnings coming out on the 16th of July, right? And that's going to really impact in terms of what this stock's going to do. At the moment, I'm more than comfortable to hold it for the longer term because it gives me that diversification. I may underperform with it, but that's just going to be my approach. Now, by the way, don't just blindly copy my portfolio. I know a lot of people do that. They look for content creators to just copy their portfolios. It might not be right for you, so make sure that you're only investing in what you want to be investing in. Next one then is Pepsi, which is the worst performing stock in my portfolio. Over the year, it's down 21%. It's really struggling with consumer tastes, is what the reports are saying. A lot of younger people are not drinking as much Pepsi, Coke, etc. And it has been absolutely smashed to pieces. Dividend yield is still in at 4.24%, so it is still a good dividend, but that's really poor performance. Look at the max view as well. So it's where it was in 2018 nearly almost. But personally, I'm probably thinking about putting a bit more money into this, if I'm honest. I don't think that's going to continue in that same direction. I think it's got too much brand power. It's got too much presence. I think globally, a lot of people consume it. And when we go into times of uncertainty as well, consumer goods, food, drink, typically tends to do okay. But not had a good time of it. Right, last one, Virgin Galactic. We'll just touch on it. So first quarter results, we saw a decline, and they only made $500,000 in sales, which is absolutely horrific. So on the max view, 99% down, 1 year down, nearly 80%, 3 months, 21%. 1 month, 40%, 1 week, 13%. There wasn't too many good pictures to be painted about Virgin Galactic, I'm afraid. But I keep it in my portfolio because you never know. And I really like the business. I like the idea of it. I love all things space. I anticipate it'll go to zero. I honestly do. But it might not. So overall then, as you can see, that dotted, the big increase in the blue line there, that's when I put my money in yesterday. £127,000 now, which is, I can't believe it, to be honest with you. When you start investing, the £100,000 is the goal that everyone wants to get to. And it is bloody hard to get there because all the growth you get. If you put £1,000 in and the market goes up by 20%, you're only going to see a £200 increase in your portfolio. So the growth to get to £100,000 comes from your deposits. And you have to be really aggressive, and you have to have a little bit of luck, despite what everyone tells you, what all the pros tell you, and how you do this and how you do that. You need a bit of luck. You need the markets to be on your side. Equally, it could be a good idea for the markets to be going down for the first 5 years that you start investing, because you're just picking it up cheaper and cheaper and cheaper. And if you're a long-term investor, 10 years plus, I'll hold this portfolio all my life. I'm never going to sell the whole thing out. When I get to a point where I can retire off it, I'll be taking 4 or 5% out every single year. But getting to that £100,000 mark should be the goal for everyone. And it's not easy, and it takes a long time, and it will take some sacrifices in order to achieve it. But once you start to get there, if I now see a 10% growth in the portfolio over the next 12 months, my portfolio is going to grow by £12,000, £13,000 nearly. So if you have only just started, there'll be some people that are watching this starting with £100. There'll be some people watching this with millions, but most of them are going to have probably less than this portfolio. I don't want you to... There's a lot of people that share their portfolio online, and it can be intimidating. It can be, I never think I can achieve that. All of these sort of things. You can. Honestly, you can. You just got to keep going. That's why I started this channel right at the beginning. If you've been watching it for a number of years, you'll have noticed I've never done any big crazy sales. I've tinkered with some individual stocks, but look at my two biggest positions. I've got £100,000 of that portfolio in the All World and the S&P 500. So I just hold those ones because I like to pick individual businesses. For most people, that's probably not the right thing to do. So keep going. Just keep going. Honestly. In the long term, you'll be so thankful for yourself. Any money you can find to put into the market, and you're happy to leave it there for as long as possible, just put it in. Right, obviously you can tell I'm in a different place. I haven't brought my notepad. Let's get the joke. Right, I'm not even gonna edit this out. You're gonna have to watch me. You can look at my nice summer outfit. That's my office, by the way. Give some perspective of where we are. That's probably where you've seen everything. Sorry about this. Preempting. Apology. Do you know what a baby computer calls its father? Data. We'll leave it at that.